Now we have liquidity down here. Let me get this out of the way. Sorry. So at this low and just below it, I teach my students, we aim for that. I don't look at that as it's going to go down here and bounce. I don't ever look at it like that. I look at price like, who went long here? I don't know. You don't know. We don't care. Somebody went long. The market went higher. So below that low, classical technical analysis is going to do what? Preach that you have to put your stop loss rate at that low or just below it, right? So what kind of stop's going to be there? A sell stop, which is why I teach that is sell side liquidity. Price rallies up, it breaks down. What just happened right here? Right below this low, it shifts. Market where? Bullish or bearish? Bearish. So what we do is we look inside this price leg here, and we look for any inefficiency. So once this leg here has been broken on that candle, that one right there, that's where you enter with the expectation of finding the setup that I taught in the 2022 model. This is exactly what you would expect to see. Now, why is that? Because you're seeing, number one, buy side taken. See these relative equal highs over here? Above this area, anywhere in your price, anywhere in your chart, I don't care what market you trade, it doesn't matter. This is like a constant thing that repeats over and over and over again. Watch this volume imbalance in here, by the way, because it could see that and then drop down in below there. But buy side liquidity here, above old highs, when the market's dropping, like it does here. If anyone went short there, where would they place their stop? Theoretically, to protect themselves. The books teach us what? Put your stop loss at the high or just above it. So the market drops down, rallies from here, and all of this area here, that's absorbing and engaging all the buy side liquidity or buy stops that will be resting above these relative equal highs. So that's what's occurring here. So what I teach my students and how I internalize price, when I see that, I'm expecting price to do what? Show a willingness to want to go lower. Because it went up here for real orders. I don't need level 2. You don't need level 2. You don't need depth of market to see that. It's plain. Wherever there are smooth edges, like these relative equal highs like this, the market, it's uncanny how it will go up there and make those smooth edges jagged. So it's all nice and smooth here, like a perfect ceiling, right? And then all of a sudden you see this smash running up, spend some time up here, and then breaks lower. This moment right here, when it takes out these lows on that candle, that is the market model that I gave you for 2022. Doesn't mean you get in. It means now you look at this price leg here. Go back through this price leg because this is the displacement price leg. This low has been taken out right there. So inside this entire run lower, you want to look at where there is an inefficiency or a fair value gap. That fair value gap is your entry point. You just don't chase it just because it went down below here. We had relative equal highs. The market runs up in here. We don't do anything. We're waiting. Then the market drops. It does so here. Do we do anything with it? No. The market rallies again. What does it do? It runs above the rejection block in here. It's in my YouTube channel. And then there's a displacement lower. So this willingness to break sharply below a swing low after taking buy side. This is how you frame high probability. High probability for a short means some measure of buy side has been taken. We see that here. Then you wait for what? Displacement. That means in plain terms, you want to see the market drop sharply lower and take out a specific low. Here's a short-term low. It trades through it here. Once we have that, then we can go back through all this price leg here and look for inefficiencies. That means a specific fair value gap. Now, once you have that price leg identified, you want to go through all your time frames. 5, 4, 3, 2, 1. Right now I'm showing you on a 5-minute chart. So we have this price leg from high to low. High to low. This is the low that was shown as a break in market structure, and not break, I shouldn't say it that way, a shift in market structure. So anything at this level or higher, we want to look at that as a potential what? Fair value gap. Now, this is the part that being mentored versus just watching one of my videos or listening to someone else try to take a series of lectures or a video of mine that may be an hour or so long, and they try to condense it to a 5-minute trainer. Learn ICT stuff in 5 minutes. You're never going to learn what I'm about to show you in those 5-minute trainer versions. Okay, I understand everybody wants to get clicks on their videos and such, but if you want to learn, there's a way of doing it correctly, and there's a way of just looking at cliff notes. It didn't work for you in school when you studied the cliff notes and you didn't get a high score. You have to read the book, right? Okay, so here's what it is. Inside this run from the midpoint of this leg higher and lower. Okay, that's the price leg that we're looking at. Why this price leg? Because it took out this short-term low on that candle. It's a shift in market structure, bearish, lower prices are expected. We do not look at any rally up as a sustainable run. Why? Because stops have already been taken above this high here. Then there's a shift in market structure below that low. That means that any rally after, establishing the midpoint here, once it goes above that, in my mind, I'm thinking we're only going up to go down. So algorithmically, the market will print and produce a premium market. A premium market is where you want to sell your long positions and as partials, or enter your short positions. When the market's rallying, that's where you want to short. You don't want to sell in down candles. That's chasing price. When you see me doing my partials, when I'm pyramiding into a position, I'm selling short in the up candle. And then I'm adding more as the candles are going up into that move. I'm not fearful of that. When I first started, I was absolutely afraid of that. I was scared. I was afraid what I was buying was a rocket. And I didn't want to get stung. I didn't want to get hurt. More specifically, I didn't want to be wrong. I didn't care about the money. I didn't want to be wrong. I wanted to be right. And being right is not essential to profitability. It sounds like it's an impossibility, because you can be right and lose money. You can be wrong and make money. So you have to do many times what seems like is the most proper way of doing it, most intuitive thing is most of the time not the correct thing to do in trading. When the market's been going down, everybody thinks, what? Well, it's going down, so let me get short. They chase it. And I was a victim of that when I first started. So that's the reason why I teach the PD array matrix, so that way we can frame a price leg, as we're doing here, the high to that low. Why am I specifically aiming for this price leg? Why am I only looking at this one? And why am I looking at this one? Because this one here didn't do any kind of a short-term price run where it created a swing low like this one does here. It rallies up, and then it overlaps that entire run and breaks it there on that candle. Once that occurs, as soon as that happens, I'm waiting for price to make a turn and start going back up. Well, what happens here? ICT didn't go above the equilibrium, price went here? No, because this level isn't the equilibrium until this low. So if we were looking at this here, did that trade meaningfully above the 50% level? No. And even if it poked its head above that, did it trade to a fair value gap that would be inside that price leg from here to here? No. So look closer. You have this price run down. We're waiting for price to go back above equilibrium, which is the 50% level on your fib. There's no mystery to it, okay? This is the only benefit of having a Fibonacci in my mind. That and how I use it for targeting. And I'll show you that stuff. And you've probably already seen many times me doing it in my live executions and managing the position, trailing the stop, looking for targets to be hit and such. But this run above equilibrium within this price leg here, that sets the stage. Okay, now we are in a premium market, meaning this range is premium. It's, in other words, overbought. I don't need an indicator. You don't need an indicator to arrive at. From this point here to here, this is discount. As soon as we leave, and again, this is, again, not in the folks that try to teach my stuff. They don't know what they're doing. And I'm asking you, please stop trying to teach my stuff because you don't know what you're doing. You're not covering things that are most salient, and you're oblivious to the things that are necessary for certain things to be really in the marketplace. This discount, okay, in the red shaded area above this level here, that's a premium. Above it or at that level, they're your ideal shorts. As soon as you cross the midpoint of the discount level here, once we get through that, I did that by eyeball. That was pretty good, wasn't it? Once we get through that there, the highest form of profitable shorts, the highest probability short entries, they have now been exhausted. The only thing you want to be focusing on now is taking partials and trailing your stop. Yes, that's a diamond. You just simply can't just take every single trade and enter and enter and enter and enter. When do I stop taking partials or pyramiding? Something like this. Now, I'll build pyramiding entries all in this until we get through here. And then I stop taking pyramid entries. Go back and look at my examples and you'll see that's the truth. So when I wanted to learn how to pyramid and build my positions large, I learned it incorrectly from Ken Roberts' rag of a book, the world's most powerful money manual, of course. It's a long title for something that was useless, like toilet paper. But I guess toilet paper is useful, but use toilet paper, let's put it that way. The idea of looking for the best entry points, the highest probability, and how the market will respect those levels more so than others. See, once we leave the midpoint of that discount range of this price run here to here, and we're in the lower portion of it, we're entering that expansion phase. That expansion phase is likely to not offer very many, if at all, new high probability pyramid entries to add to a position. So there's a threshold at which I will no longer add to new existing positions. But while I'm in that premium area, within that price leg, within the market structure that I'm looking for, as I just outlined here, and again, you're going to want to watch this portion of the video several times, it gives you the highest degree of probability for delivery from your entry to your targets. And you don't want to chase the move and build in more position once it breaks through the threshold I just outlined here. Because to do so, number one, you're going to be worrying about trying to put on another position versus taking off some as it moves in your favor. It's crucial in the beginning for you to do those types of things. Now, for someone that's seasoned, they've been around for a long time, you know what you're doing, you know how to profit, you know how to look at targets, your targets are not unrealistic, and you can go to full terminus. That means your full target, where you aimed for when you first got on the trade. In the beginning, and this is who I'm talking to right now, when I'm doing these live streams and I'm talking to the students that are here listening, I'm not talking to the guy that's been doing it for 5 years and he's funded and he's got profitability. You can glean what you want to glean from what I'm teaching. But it's the folks that are brand new. They have no idea where to go. They have no idea what to do with this information, how to use it, how to frame the logic. What rules do you follow? What do I do? What do I don't do? That's what I'm trying to accomplish with these lectures and obviously with the live streams. So once the market starts to draw back up into this premium area, we have to go through our time frames and look for fair value gaps. So right away we have this low to high. Let's go back in with the fib. So we have to go into a fair value gap at or above equilibrium. So from this point on up, we can look for what? A fair value gap. Is this a fair value gap? Yes. What if you sold short there? Would it be profitable? Yes. Where would your stop need to be? Here it needs to be at the high. That's a lot. That's a lot of range. But I don't want to have a stop loss like that. Okay, but you're going to have to be more selective with your entries then. Now look closer. Inside this price leg here, this is why I'm not supply and demand also. What is this? What's that? What's the separation between this candle's close and this candle's opening? Volume imbalance. The volume imbalance has no body between two close and or opening prices. So it can be a volume imbalance between a higher close and a lower opening, or it could be a difference between a close with a higher opening. That's the difference between the two potential volume imbalances. The wicks overlap. See how it has a small little wick right here? Let me see if I can. How can I do that here? I know there's probably a shortcut to do this, and you guys are saying, if you would just do this, ICT. There's a small little wick here and a small little wick right here. Whenever I'm looking at price, I'm looking for those types of things because that's a signature. That's a little glitch in the matrix. Think of it like that. So if you take that and draw it through, because we cut through candles, Sam. We're not supply and demand around here. If you cut through all this drop as it's retracing back up, what's it reaching for? It is reaching for an imbalance in here. Yes, there's one here with this candle. There's one here between this candle's low and this candle's high. And then we have one here to here, specifically with that candle. Which one is better? Yes, you can enter here and have a stop loss up here. But look closer. In this delivery higher, when it ran higher, what is this last up close candle anyway? It's a bearish order block. Why is it a bearish order block? Because it has a fair value gap. Opening price on this candle is what? You're going to look right here. Opening price on this candle is 4130.00. Okay. What's the high on this candle here? You're looking right here. The high of that candle is 4130.00. You cannot improve on perfection. That's algorithmic. What's the high on the next candle here? 4130.00. Again, not one tick off, not one tick over, not one tick short. So if you had a series of fair value gaps, which one do you look to trade to or use your entry at? Look for the bearish order block, look for a volume imbalance, or a fair value gap on the other side of the drop. You extend it through. Again, we cut through candles. You can't, I'm not trying to be so dogmatic in the live streams, and I'm trying to control myself because I will literally go into a Twitter rant and just not be as productive as I'm trying to be. There's certain things you have to look for, and I can't teach you every possible scenario that's available in the future because it's better to see it live, explaining it live. Then you're looking at this saying, well, that's not live. It already happened. I understand that, but I'm showing you the logic that one would use to get to the delivery on this setup, which is exactly out of the 2022 model that was shown to you last year. So with that volume imbalance and the fact that it's above equilibrium on that price leg right here. So the first one you can come to, you could go short there and your risk would be to that high. Trading at this one with the volume imbalance and the fair value gap, and now watch. What's the half of this up close candle? Remember what that was? What's the half of an order block? It's not consequent encouragement. Consequent encouragement is any inefficiency. A fair value gap, buy side imbalance, sell side inefficiency. Those are consequent encouragement midpoints. A candle, a range, a specific candle that's been delivered in price, the midpoint of that is mean threshold. Low to high is 41.31 and a half. So if you were taking this fair value gap, joining it with the volume imbalance, and it's a bearish order block, price should not do what? It should not trade above the midpoint of that up close candle. So your stop could be at 41.32. 41.32. So that means you have a 2-handle or 2-point stop loss entering within this volume imbalance, within this fair value gap. And if some of you are new, you have no idea that this stuff is repeating like this. And I walked you through an example, something like this in the stock indices last week. I said, I wanted to use a fair value gap for a resistance level. And it stopped dead in its tracks, just like this did here. And I executed on it, and I showed it to you. So it's not cherry picking. It's not looking at hindsight only. You have to study hindsight. Every trader that's making money right now, that's profitable, they learned by studying hindsight. You have to understand what the concept looks like. You have to identify it. And that way, by seeing it, like when you go out and you learn how to hunt and track your prey, you spend a lot of time looking at tracks. Oh, this is a bear, this is a elk, this is a deer. And that's the only way you can identify what it looks like, because you have to see it in the history. Where has it been shown before? But once you understand the basics of the pattern, the setups, the primary framework, then it must be studied on real-time data. And it doesn't mean studying by pushing a demo account or studying with a live account. You do not learn anything correctly by doing that. There's a step in between that everybody skips over because they're in a hurry to be profitable. Versus, I want to take my time and be systematic. I want to know that I'm doing what I'm supposed to be doing and avoiding the things and not being influenced emotionally and psychologically because of the money. Because as soon as you put a trade on, you're worrying about the P&L of that trade. You're not worrying about the price action. Your mind shifts from managing the risk and managing the trade versus, now I hope I don't lose. Is this thing going to turn around and go after my stop? And it may not even be close to your stop, but most of the time it will, because you're in a hurry to do what? Jam your stop loss up. And that's not what a profitable trader does. Profitable traders aren't in a hurry to race their stop loss to break even. They're not concerned about that. Why? Because they've been here before. They know that even if this trade fails, it's not going to end their career. It doesn't undo the efficacy of their model or their approach to trading. It just means that was one human transaction that they made. They placed risk behind it, and it was wrong, and it didn't deliver a favorable outcome. But you can still learn from that. And it doesn't unsettle you as a profitable trader that you don't say, I'm going to change what I'm doing. I'm going to change my approach to trading because I had a losing trade. Now, in the beginning, that's exactly what you're going to want to do. As soon as you try to learn from me or learn from someone else and you suffer a losing trade, the first thing you're thinking is, okay, this doesn't work. Let me go to something else. And I did that. I did that for years. And I had a winning model, but I kept tinkering around with it until I realized I was holding myself back. So that's how we go through the process of looking for the right fair value gap. Now, if there's no volume imbalance, or if there's no fair value gap here on the other side of the displacement leg, then I'll use the first fair value gap above the equilibrium, and then there it is. Now, another version of this would be using this. And I usually do this if I'm going to be building a large position. Like if I know I'm going to be building a large pyramided position up, I'll use this run up where it takes, right before it drops down, it takes a shift in market structure. So this is the displacement leg. Okay, this leg here, you split that in half. You would use any fair value gap, any fair value gap at this level, and here's your sell side. Look what we just talked about there. Let me finish this thought here, and then I'm going to talk about this volume imbalance I mentioned. This leg here to here, if we had no volume imbalance, if that wasn't there, I would take this low to that high, the equilibrium there, drag that through. This would be the fair value gap at that moment. So then I would be doing this. Again, this is assuming that there's no volume imbalance. My entry would be here and framed on this fair value gap there. Show me how to pick the right fair value gap. I just did. Did you write it down? Did you record it in your log? Did you journal it? No. You're watching it like Netflix, and you're going to never learn. So there's the logic. Okay? And there's the sell side. Now let me take your attention right back down into here, because I told you, watch this volume imbalance. You know, one of those cherry picking events. If you go over here, the separation between the candle's close and the candle's opening, you want to get real used to doing that in your charts. When you see that, your eye's going to jump to it. Do you see it here? See that right there? That's a volume imbalance. That's a glitch in the matrix. Okay? They're coded. They're there for a reason. Right there. See it? Just like it was here. And there's one here. And there's one right there. So when I look at price, my eyes jump to fair value gaps, swing highs, swing lows, volume imbalances. That's just where my eye goes. Okay. Here, think about what I was talking about before we drop down into the sell side. I said, watch this when it was trading up until here. So watch this volume imbalance. From this point here to that low, what is that? It's a PD array. It's an area where you expect price to react. React how? I framed all this here, but before I went on all the business up here, I said, watch that low. I believe we're going down below that. Now, I already know some of you skeptics in the audience are sitting here thinking, well, big deal. You know, it was this big run. I have hundreds of trades where I'm doing 100 handles or more. You can use the same logic to do those trades too. I am teaching you this year how to do a 5-handle run as a starting point. That is not to say that your entire career must only be on the basis of a 5-handle price move. It's to get someone that has never traded a low-hanging fruit objective. And I don't think there's anything wrong with that. Because if anybody in here that's an educator or teacher, they have a first threshold objective, something that they teach their students to aim for. I'm just electing to say 5 handles in the S&P market when you're paper trading and you're demo trading and you're tape reading. If you're looking for that, number one, if that's all you ever get to be consistent with, that's enough. It's absolutely enough. You can take that same little cookie cutter approach of 5 handles and put money management behind that. Money management behind something that is effective could produce many, many 5-handle moves over and over and over again. And it compounds, and you use the power of compound interest to do the heavy lifting through money management. You're not risking more. You would be, I guess, risking more comparatively from where you first started as your equity base when you first start trading versus 5 years into trading, your risk isn't any larger percentage-wise. It's a fixed rate of percentage risk that increases monetarily, but never percentage-wise. So the heavy lifting is done by money management, not the bigger positions coming in. I can do that. I can do heavy-handed trades. But a learning student, first introduction to trading, first introduction to what I'm trying to teach, it would not be efficient for me as a mentor to try to waste my time trying to build you up to try to do these big heavy-handed trades in the beginning when you don't even know how to read price. So the way you learn how to read price and you feel rewarded because it's more frequent that you'll see a 5-handle move than a 100-handle move. There's many 5-handle runs intraday versus how many 100-handle runs is happening intraday in one sustained run. It's not happening that often, right? So by framing the logic like this is where the stops are. What kind of stops? They're sell stops, so that makes it sell side liquidity. The market's going down up here, so where would it go? Down to here. Why? Because smart money and the algorithms that are in the marketplace, they engage these levels here. So what's above that? Buy side liquidity. In short, it's what? Buy stops. So what happens is the buy stops get tripped in here. Smart money, traders like myself and who I'm teaching my students to be, they will accumulate short positions against these buy stops with the expectation that they will ride price lower to this low. Why is that advantageous? Because below this low is sell side liquidity for anyone that has been long here and rode it up. I'm not saying that there aren't traders up here trading without a stop loss or trailing their stop loss up tight and had been already knocked out. That's not what I'm saying. Algorithmically, the market will remember and refer back to that low. It does not know how many stops are actually below the low. It doesn't need to know that. It just needs to reprice at that level. Then the people that are in the marketplace, quote unquote, smart money, the composite man, they will use that liquidity as a counter to their shorting against the buy stops up here. So basically, it's the game of tag. Tag, you're it. Buy stops are it. Okay, so now who's next? Sell side. Tag, you're it. Down here. So in essence, smart money sells to buy stops with the expectation that they're going to run lower in price and then buy sell stops. Now, you don't learn that in books. You think buy down here support, sell up here resistance. And I take my students' understanding about the marketplace and turn it upside down. Because inside the upside down is the clarity that you're looking for. The frustration is immediately removed. So now let's go back. The volume and bounce I mentioned live before it actually delivered to you. Inside this area, if we hadn't already moved so far away here, I would use as an entry. Why wouldn't you take that as an entry? If you knew and you said it was a volume imbalance cycle, you said there was a sell side liquidity, you said it was going to likely go down there, why didn't you take this as a trade? Why wouldn't I take that as a trade? Because of what I've outlined up here in reference to the premium and discount range. Once we leave, if we're bearish, once we break through the midpoint of discount, I cannot take another new entry. You can. I'm not. I'm managing now. I'm managing my core position. That's it. It's over. This becomes a point of interest where I'm going to see the trade be managed with it. I am not going to put my stop loss below that volume imbalance. I'm not going to trail it down there. If I see that volume imbalance, as I mentioned real time, said watch that area, my stock could be above this high. It could be at the middle of this up close candle mean threshold because it shouldn't go there. Why? Because I'm expecting this volume imbalance to keep price from wanting to rally all that. Why? Why would I expect that? You see this opening here? We rally up. We drop down. All of this range between from the low and the high, that range has already been delivered to this low. So 41.18. The next candle here, we open, we drop down, and we roll right back over top of 41.18. So we had 2 times between this candle's high and this candle's low. This entire range oh, you're learning today. School is in session with ICT. So inside that range, this is now balanced because we've had delivery to the downside. We came off of it. We went down through it again, and then we left what? A volume imbalance. So it's highly, highly unlikely that the market's going to do what? Think. What do you see in here? I've been recently teaching a lot about it. That low to that high. What's that price? It's consequent encroachment. Wait a minute. You said that's for gaps and fair value gaps. Yes. A wick is a gap. To an algorithm, they view a wick as a gap. Midpoint of that is consequent encroachment. What price is that? 41.19 and a quarter. So my stop would have to be above that. Trusting that it would not go above that. That's stop management. That's how you understand what you're looking for. And we got about